What's the right policy for infinite banking? We're going to talk about IULs versus whole life and how you would create very real wealth with infinite banking and having the right structured policy. Now, first of all, I'm not a financial advisor. I don't get paid for this. So I'm going to tell you the truth behind what you are sold. I'm going to give you statistics. I'm going to share my own experiences with my own policy and what I've been able to do with it. And I'm going to expose the truths about the industry that a lot of people do not know, so that when you go to do this yourself, you are protected, you have better knowledge, and it's unbiased. Okay? That way you know you are not getting persuaded to buy something that doesn't do as well for you as it could. Okay? If you're brand new to my channel, my name is Ben Oberg. I am all about building wealth like a capitalist and deploying into hard assets that create cash flow. I keep my money where it makes 8 to 12% before I've even invested it, and then I go into cash flowing assets that double my money or better every few years, and I repeat that process. I'm not into retirement accounts or strategies that have you waiting until you're 60 before you can access your money. So you've maybe heard me say before that 95% of policies sold in the United States are term, IUL, or VUL, all right? And advisors have been incentivized to sell these products that do offer them 50 to 90% commissions, okay? We'll get to the wealth building statistics and how we multiply our money way faster than a retirement account in just a little bit here, but this is for you if you're trying to create wealth, if you're looking to become your own bank, if you want to get out of the modern financial system, if you want to create more leverage, if you want to pay less taxes. It is for you, whether you are a multi-billionaire, a multi-millionaire, or you're just getting started. I don't care if you're 20 or 50 or 70 or 30, this video is for you. So 95% of policies are IUL, VUL, or term. Term is Dave Ramsey's favorite thing. It's buy term and invest the difference. Dave Ramsey is invested in term life insurance companies, okay? Dave Ramsey makes a little bit more wealth every time he says that and somebody listens. When you look at IULs and VULs, they are typically structured in a retail manner. They are not structured for what we call high early cash value. And in a second here, I'm going to talk about, in my opinion, what the holy grail cash value infinite banking life policy is, because I have one myself and it works very well. Now, these IULs and VULs do a couple things that don't work very well, all right? IULs are advertised as having a 0% floor. Okay, meaning that they cannot lose money, right? And that's sold as a benefit. But they also have caps, meaning that they cannot participate in the full market upside. So you can never get the return of the full market. Now, they often have rising internal costs that unfortunately are not sold or represented to you very well, or hidden in the contract. And let's face it, who reads 60, 70 page contracts? This should be something that advisors disclose, but they often don't do so very well. The next thing is, if you look at what is called IRR, internal rate of return, they typically will be 4 to 6%. That's not very good. To put that in perspective, if you have a 6% IRR, it will take you a very long time to double your money. Take the rule of 72, divide by 6. It's going to take you 12 years to double your money at a 6% IRR. I'm familiar with policies that have double that in IRR, okay? When you go into variable universal life policies, the reason it says variable is because it varies. It has more risk with it. And oftentimes you can choose the investments. But if you don't know tons about the financial world and you don't understand where your life policy is being invested into, then that can be a reason where you are your own catalyst for failure. Okay, so I do what's called whole life. Now, I want to debunk a very common myth in the room, all right? And again, I keep my money where it makes 8 to 12, and I invest where I'm doing at least double every 5 years. That is my rule. You'll hear me say it multiple times. I keep my money where I make 8 to 12, and I invest where I can do double or better every 5 years. If you have a financial advisor that cannot do that for you, that doesn't possess the knowledge, that doesn't have the investments, that doesn't have the deals, that doesn't have the connections, that doesn't have the infrastructure, that don't understand the taxes, why are you paying for them? And to address the people that are watching this video right now that think this doesn't exist, no, it doesn't exist for you because you haven't developed the knowledge or the skill set enough yet. That is why some people stay at the bottom, some people get on the top, and maybe you're somewhere in between. So if you want to level up, learn more, okay? Whole life, it's separated into a couple categories. You have retail whole life and you have institutional grade. We don't touch any of this over here. We do institutional grade whole life. In retail whole life, which is what the majority of advisors that sell whole life can actually offer and know to offer and are familiar with, you don't have design for high early cash value. The reason this is so important is because you want to have a policy that allows you to stack cash in it as quickly as you are able to. And you want to have a policy that allows you to do that so that you have more cash value generating a return earlier on. That's why there's this term HECV, high early cash value. So the banks buy what's called BOLI, bank-owned life insurance. Not too long ago, a bunch of banks ended up buying cumulatively about $11 billion worth of bank-owned life insurance, right? And the reason they do this is because they know they can get high IRRs. While they're lending your money out at 6 or 7 or 8%, 10 times over, right? And paying you 0.5 point, 1, maybe 2% in your high yield savings account, they're making 10, 11, 12, 13, 14% in their BOLI, all right? So what I encourage, and this is not financial advice, this is just based on my own success and knowing many, many, many people that do this, you get an institutional grade, dividend paying, mutually participating whole life policy from one of the good carriers. We're talking about companies like MassMutual, Northwestern, Guardian, New York Life, or even Penn Mutual, okay? MassMutual has never been beaten in their dividend by any company. Northwestern's gotten close, but it hasn't been beaten. And in the last 50 years, their dividends never been lower than 6%, all right? And when rates go down, dividends are usually inverse of rates. So last year, the dividend was 6%. This year it's 6.4%. This is tax-free, by the way. Rates dropped on the 17th of September, 25 basis points. So there's a potential for that dividend to go up even more. You also get what's called a guaranteed return. This guaranteed return varies between 2 and 4%. And again, policy design is everything. People of different ages or different goals might get different returns. My policy is a 4% guaranteed return, and I have that 6.4% dividend. Now, when you fund a whole life policy, there's millions of ways to do it now, and you can do a chunk a year from now. You can contribute monthly. There's a bunch of different ways to do it, all right? What I like to do is save up a little bit, maybe 10,000 or more. Of course, the more the better, but it becomes impactful when you're working with any numbers above about $10,000. And I did what was called a HECV, a high early cash value. And I have far more than 10K in there now, but it was called a high early cash value. And that allows me to prioritize the cash value, keep the insurance costs as minimal as possible, the death benefit a little bit lower, because this policy is designed to create wealth while you're living. It's not term, Dave Ramsey, it's wealth while you're living, okay? And when you start contributing to this policy, as time goes on, that IRR can increase, okay? And when you really start going here, you get into that zone of 8 to 12% IRR, okay? Again, if I've got an IRR of 14.4%, I'm doubling my money every 5 years. So to have 8 to 12% where you're saving your money before you've even invested it is pretty damn good, all right? So that's what I do. When you open one of these policies, typically, depending on the policy, you'll get access to 70, 80, 85% of the cash value within 60 to 90 days of opening the policy, all right? Do not touch that cash value, okay? About a year goes by and that full 100% of the cash value is accessible, all right? Now here's a term I want you guys to understand. There's what's called direct participation and non-direct participation. Direct participation means you can do what's called a policy loan. So let's say I have $10,000 of cash value and I want to use it to go invest in things that pay me a return so I can infinitely bank, become my own bank, and build wealth. Well, if you are in a direct participating policy, when you borrow out of the cash value, it stops the growth based on the amount you borrow. So if I have $10,000 of cash value and I borrow $8,000, until I have that paid back, only the remaining $2,000 is accumulating a dividend, a return, okay? So you don't want that type of policy. You want what is called a non-direct participation, okay? A non-direct participation policy. What this means is that non-direct participation policies allow you to borrow from the cash value, but still get growth on the entire amount. So if you've got $10,000 of cash value and you borrow 4, 8, 6,000, or all 10,000, it's still growing as if you didn't touch it, all right? That's non-direct participation. That's very important. I'm gonna take it a step further. I have a non-direct participation, high early cash value, whole life policy that I have a line of credit against from a third party. And the reason I do that is because I have found that third party lenders will oftentimes give even lower rates. I'll give you an example. Having a 5.25% line of credit, and these vary, could be as low as 4% I've seen in some years, as high as 7%, but to have a 5.25 line of credit when an IRR in the policy is 8, 9, 10, 11, 12%. So I'm borrowing against the policy. It's continuing to grow at a really low rate. The policy is continuing to grow. I have a line of credit against it, so the cash value is not being touched at all. And then I use that to go make investments, all right? So there's many reasons to kind of come full circle on here why I prefer whole life, all right? Higher IRRs, okay? I don't have rising internal cost over the years in a properly structured policy, properly structured. And for all the advisors on here that are gonna combat me, you sell retail. You don't know what I'm talking about, and you're probably not licensed to sell it. You're probably not even in the system of these companies listed as a licensed advisor to sell institutional grade. So your opinion is entirely invalid. I'm talking about institutional grade. And when you understand these things, you're able to save your money in a vehicle where you're getting a higher internal rate of return than you would on your VULs or your IULs, okay? You're accumulating cash value faster, and all I do, guys, is I take my earned income and I do what's called overfunding. I overfund this policy, okay? Until I am approaching a limit. There's a limit to how much you can overfund, okay? And we can get into those details in another video. And if you do approach that limit, nothing stops you from opening up another policy and starting with a bigger amount, or transferring the cash value from this one over to the next one, okay? You can do that. It's called a 1035 exchange. And so I have a higher IRR, I have a tax-free dividend, I've got a third-party line of credit against it, and then I go into appreciating assets, whether this is investing in businesses, whether this is going into oil, whether it's going into real estate, all right? Now, I don't want to make this video too long. I've included a link in the description to the Capitalist Network so you can get access to these types of policies, my partners that set these up. You get access to the real estate funds that I'm in, the oil funds that I'm in, the tax strategy, the CPAs that I work with. Everybody that I personally use to build wealth is all under one roof. There's a 7-day trial that you can get for free. The link is in the description. The nuances that I want to explain when it comes to investing are the following. Okay, you've just learned about a whole life policy. You've just learned about a HEC-V policy. You've just learned about a dividend paying whole life policy, an institutional grade one. I've taught you about how I use a line of credit at a lower rate than the cash value growth in my policy. Okay, I want to dive into what I use that for. So if I'm borrowing at 5.25% and my policy is making more than that, I'm hedging inflation and my cost of money is 0 because I'm borrowing at less than the growth of my cash value, okay? Free money, think of it that way. Think of it as free money. I have become my own bank, and now I'm gonna buy cash flow. So now I go into oil and real estate deals, all right? Again, I've made other videos on investing in oil and investing in real estate, so check out my channel for those. But to just keep it on the macro, I am not a landlord. I only passively invest in real estate. I invest in markets like Kansas City, Northwest Arkansas, and areas where you have high year-over-year rent growth and good appreciation, a diversified job market, so it's very recession resistant, won't get taken down by something like COVID or something like that. It's landlord-friendly laws, all right? People got to pay their rents. They can't just stop paying rent because they don't feel good or they're trying to figure out what pronoun they want this week. They have to pay their rent, all right? And those areas allow me to do 19, 20, 21, 22% IRRs, where I am doubling my money in 3.5, 4-year periods of time, all right? Now these real estate deals, I'm usually in for 5 to 7 years, but because their IRR is 19, 20, 21%, I'm doing 2.3, 2.5, 2.6x in these deals. I'm getting depreciation on the passive income. So I take my earned income, which is a high tax bracket, right? I fund these policies. I borrow against, all right, which is not a taxable event. I invest in assets that are tax friendly, create cash flow, allow me to duplicate, and allow me to multiply my wealth. And I do so specifically in oil and real estate. All about this inside TCN. Any questions you have, please let me know in the comments. I reply to anything that is an intelligent question, and I also reply to the hate, all right? So if you've got something to debate, let's debate. I will put you in your place and show that you are misinformed. Appreciate you guys. Make sure to subscribe, and I'll see you in the next video.